So why do companies care about whether their stock price goes up or down? You may have seen in some of my other videos where I talked about the fact that the movement in the stock market, so prices going up, prices going down, don't really have necessarily a direct impact on the company. Now it does actually, but not in the way that you probably think. So with that in mind, why is it that they do care about the stock prices? What does it matter to them? Now, maybe you didn't see my other video where I talked about how the whole IPO process works, but we'll just briefly go over that. During the IPO process, the stocks are sold for the first time. So the idea is that the company, let's say in this case Carlyle Enterprises, is looking to raise money, and it's going to do that by going public. When it goes public, in this scenario, we have Carlyle Enterprises generating 10 million shares and selling those shares to investors. Now, the investors pay Carlyle Enterprises $10 million for those shares. So now Carlyle Enterprises has $10 million in cash as a result of generating these shares and selling them to the market. The thing is, no matter what happens afterwards, like in this case, we see the investors actually made a profit. They have $200 million in cash now as a result of the initial IPO price of $1. The price of the stock later on went up to $20. So they had a tremendous success in terms of gains on the price here. And through that gain, they were able to actually sell the shares that they bought from Carl Enterprises to other investors, and they profited $200 million. So why do they care? Because you can continue increasing their stock prices going up and up and up, and all these guys are making money. Meanwhile, the company's not making any money off of this directly. So why do they care? Well, let's talk about that. There's a couple of reasons why they care. Number one of the reasons, and this is not in any particular order, one of the reasons why they care about the stock prices is because a lot of times the people who work in the company, so people at Carlyle Enterprises, are going to potentially be majority stockholders or stakeholders. They're going to have actual shares of the stock of their own company. So, for example, I'm CEO of Carlyle Enterprises, and I could have a a very large position of stocks in my own company. So therefore, if the stock price plummets, so we had an IPO of $1 and it goes down to, well, $1 is a very low price, so it can't really plummet that much from that, but let's just say it goes down to zero point 0.1. That could be a huge hit. That could be a huge hit to my net worth. I mean, massive amount of money lost in terms of money out of my own pocket. Now, not in terms of liquidity or actual cash, because I actually just have the stocks. So I had the potential to get cash by selling those stocks, but I didn't actually have cash. In order to get cash, I'd have to actually sell my shares. But the bottom line is, I started out with potentially millions of dollars worth of stocks, and now, let's just say I had purchased 10 million. Obviously, I couldn't purchase all the shares. That wouldn't make any sense. But let's just say that there was a lot more money involved here, and I had $1 million worth of shares. I could cut that in half to $500,000 based on the stock price going down. So, bottom line is, just to keep it simple, people in the company, there's a high probability that they have a good amount of shares in their own company. So therefore, just like everybody else, just like the secondary market and all these people, they can be affected. But this is not on a corporate level. This is not to say, Carlyle Enterprises has shares. It's Carlyle, the CEO of Carlyle Enterprises. It's my CFO. It's my managers, whoever it is that I offer these stock benefits to. Those are the ones who and this is a kind of a personal thing. This really has nothing to do really with the company or a business side. This is really my personal account. So think of it as, I buy mutual funds or whatever. Has nothing to do with my job, nothing to do with the company. This is my own personal financing. I have purchased a large amount of stocks in my own company, and therefore I profit from the gains in the market. So that's one of the reasons why I'm kind of motivated to make sure that Carlyle Enterprises is the best that it can be, because I have a financial stake in the success of the company because of my this amount of shares of stock that I own. Now another thing is, when people buy stocks from a company, they are actually purchasing partial ownership in the company. So all these investors here, out here that are actually buying these stocks and trading them back and forth, all these Carlyle Enterprises stocks, they have partial ownership in the company. So if Carlyle Enterprises is really going downhill and stock price is tanking, I mean it's down to 10 cents, that's ridiculous. Just got delisted. These investors are going to be hurting and they're not going to be very happy about this. But guess what? You have to remember they bought partial ownership in the company. So what does that mean? What does that entitle them to? That entitles them to partial authority in the decision making in the company. So what can happen is, let's say some guy, Jimmy, whatever, he's has a lot of money. He's one of the investors. He can get together with some other investors that have a lot of money as well, and they can start kind of a not really a takeover, but it's a situation where they can try to push out management. So we think the CEO, me, Carlyle, they think CEO Carlyle is not doing a very good job, so they can get together and start buying up a lot of shares of stock. Now this stock is cheap, so they can easily do this now because of the fact that the company's doing so poorly. So they can cheaply go and buy up all these shares and become majority shareholders, and now they have a lot of potential weight to be able to say, you know what, we want Carlyle out. He's not doing good for the company, so we're going to have our shareholder meeting and we're going to try to push him out of the company. So that's another reason. You want to make sure that you don't have shareholders that gang up on you and try to push you out of business. Not a business, but push you as a manager, push you out of there. So that's your motivation. Now, another thing is, I mentioned takeover. An actual takeover, you have not investors as far as individuals, but corporations now. Let's say one of my competitors has deep pockets and they see that Carlyle Enterprises is falling apart. Look at how cheap the stock price is. We could buy them out, because once you're going public, you're exposing yourself to the potential of a hostile takeover. So not only now here you had investors that are trying to assert their authority because they are shareholders, so they have some authority, some partial ownership of the company. We're talking about now a corporation, actually trying to gobble up this company, but buy the whole company. Hostile takeover, taking advantage of how cheap the stock price is. So as a company, you want to make sure you keep your stock price so it doesn't get too low. To where you open yourself or expose yourself up to a potential hostile takeover scenario. Now, another reason why the companies will care about their stock price, even though they're not being directly affected by the prices going up and down, is also you have to look at a corporation somewhat as you would an individual when you're talking financially. What happens when you have good credit and you need to get a loan? You get really good rates, right? In theory, you can get really good rates because, you have good credit. So, lenders trust you and they will lend you, more money, and they'll lend you at more attractive rates because they have a higher confidence that they're going to get back, you're gonna pay back the loan, right? Now, if you think of a corporation in that similar aspect, then think about corporations that may need to do things like get loans. They may need to do loans or do things where they need to be evaluated by a third party. So some kind of a bank or something is going to evaluate Carlyle Enterprises. So Carlyle Enterprises wants us to lend them $2 million for some kind of investment thing that they're doing or whatever. So we're going to do a lot of analysis of the health of the company, whether we want to lend them this money, and then what kind of rate we're going to lend them the money at. Now, one of the things, just like you would look at an individual, you look at their credit record, one of the things you look at of Carlyle Enterprises is you want to look at their stock performance, because a company that has good stock performance, it's an indicator that the company is profitable. There's high level of confidence in the company's success and how they're running things in terms of industry-wide, and that's highly reflective of potentially how good the company is doing. I mean, if the company's not doing well, the stock price is not probably going to do well. Do you want to loan a lot of money to a company that's not doing well? Do you want to loan it to them at attractive rates? Not necessarily. So you want to keep your stock price at an impressive level, so therefore you can get the loans that you need and get them at good rates. It's all about the bottom line. All this stuff matters. If you can save the company a lot of money by getting more attractive rates on loans that you may need to get. At the end of the day, when you look at the checks and balances, you look at your balance sheet, it's going to look much better for you than if you were basically incurring additional expenses based on, stock prices down, so you're getting really unattractive rates on your loans. That's all going to affect the bottom line and how you're going to look at the end of the year. So that is yet another reason why you would want to be concerned with how your stock price is doing. So another thing you want to look at is you want to look at pretty much how the company is perceived by the market. So if the stock is doing really well, then you can actually get a lot of free publicity because you'll have, you look at companies like Apple. Their stock was doing so well for so long, and every day all you could hear about is Apple this, Apple that. That's all free publicity, man. And like they needed it. They spend so much money on advertising, so many commercials and billboards and all this kind of stuff. And on top of that, they're all over the financial news. Apple stock is up, 20% or whatever it is. That's free publicity, and all that is leading to a more successful company. Look at how the whole thing works, man. So your stock price is up. So therefore you have happy investors. So the investors are not going to challenge you. Stock price is up. So the risk of, having a hostile takeover is low. Right? So that's another positive as well. Stock price is high. So when you need loans, you get attractive rates. So that's more money in your pocket. Less money you're spending on interest on the loan. So that's more money in your pocket. Stock price is high. So everyone's talking about you. So it's more marketing. So free marketing, attractive rates on loans, happy investors, protection from hostile takeover. These are all reasons why a company would be interested in their stock price. And then, of course, we mentioned one of the first things was the fact that you have shareholders within the company. There's people in the company that have shares of stock in the company as well. And especially upper management may have large stakes in the company. So therefore, they can watch, potentially, depending on the scenario, they can watch their entire fortunes dry up based on the stock price. Because if you have a huge stake and then the stock price rises in tremendous amount, maybe your value of your positions could be in the millions. Maybe you have a $15 million position, and then the stock tanks and goes all the way to getting delisted in a penny stock. So now your millions and millions of dollars worth of shares are now worthless. So essentially, you just took a huge, multi-million dollar loss as a CEO of this company. And this is, again, your personal finances. So those are reasons why the company actually will care about the stock market price, even though they are not directly affected in terms of, like we said before, the cash that they make from the initial IPO when they originally sell the shares, that's it. They don't profit again after that. All these gains with the stock prices going up and down, that's these investors in the secondary market going back and forth and experiencing gains and losses, gains and losses, gains and losses, while this company remains stagnant at whatever they gained initially. Now, any gains and losses on their part would be a direct result of their business. So all this internal stuff, nothing to do with the market. So how many units of whatever have they sold this year? What are their liabilities? All the normal stuff, which has nothing to do with the market. That's what's going to affect their cash flow, profits that are coming in versus how much money that's going out. That's their world. That's what matters within the company. But again, the stock market itself, the stock performance itself, can indirectly affect the company and therefore motivate them to do better. So now there you have it. That is how companies perceive their stock price and why it matters so much to them. You're watching Carlisle Speaks Wall Street. If this video was helpful for you, finally explained some things maybe you didn't understand before, definitely thumbs up, subscribe, share the video, and thank you so much for watching.